And we're live, guys. Thanks a lot for tuning in for this week's Tuesday night lives with Birchie. Just wait until a few of you guys get on board about today, and lots of exciting things happening in the world. So just waiting until a few more of you get on. If everything is all good, everyone can hear me, just send a little message, smash up the like, and we will get on with this evening's live. I can start seeing more viewers are popping online now, which is good. Cool. So, yeah, got a few news articles to go through today. Just saw a funny one, caught a funny one and printed it off just before I decided to go live a little bit later because I thought this thing here is pretty funny. It's humorous. The text on it says it all. I'm not going to say the word. It's been 3 years now. 3 years. We're entering 2023. We're no longer into 2019. And I have never, ever once said this word here. This one here. Never, ever said it. So give myself a little pat on the back if I do, right? That's pretty good. Pretty good effort. Never slipped it never slipped it out. So hopefully, yeah, everyone's having a good week. So, getting onto this article, I found it interesting, right? We're on the verge of a massive economic recession, and I think this is much worse than what I initially predicted back in 2017 and 18 when I came out saying the global financial depression. And what did they do when we were entering into a depression in 2019 or 2018, 2019? Lo and behold, they came out with something that was like this, right? And they had to cut rates and stimulate markets and economies and boost up, artificial sort of markets and create these bubbles. So it's interesting. We're entering into a time now which I'm seeing a lot more bad things coming out of the market than what I did back in 2017 and 2018. And to be quite honest, I'm very excited by what I'm seeing because it just means opportunity. So tonight's episode, I'm going to be talking about the benefits of a buyer's market, how you can take advantage of opportunities out there. Me being myself, I take pride in thinking that I'm an ambulance chaser and picking up things when there's good opportunity. I don't mean that by taking advantage of situations. I mean that by placing myself in the right opportunity to take advantage of the things that are in front of me. And it's being awake, and it's being alert, and it's being aware of the surroundings that are around you. So, yeah, looking at this, it's pretty funny. There's a new illness that's coming out. That's not funny in itself, but it's just interesting timing, right? We're going into holiday season. There's a push for people to go and get more of, this is just a screwdriver, right? But imagine whatever, right? I actually had to go get a blood test today. The first blood test I've had for many, many years, just checking up on my health. But they've got an agenda, and suddenly we've got a new outbreak. So here we are. This is an attractive looking woman or person, should we call? We don't want to give them descriptions, right? This is an attractive looking person here. I'd love to get health advice from this person, but the experts are warning that there is a new wave after a rapid surge of cases were recorded. New South Wales CHO Kerry is urging people to stay home, right? What happens when you stay home, right? They have to give you government stimulus packages. They have to start dropping the interest rates. They have a reason for blaming things, right? I didn't think that they'd bring this thing back. I thought this thing was gone, right? I thought they'd finished this season and we're going to enter into animal season, or I thought we were going to enter into climate season. I thought we were going to enter into a different chapter than this one, but it's interesting that it's back. It says Australian summer plans could be disputed. It's cut off a little bit here with a new wave of the number thing expected to intensify. The Paul Kelly has said increases in the case numbers is due to a new strain of the which has taken hold overseas. We're currently seeing an increase of the said illness in Australia, reflecting community transmission of the variant XBB. Where do they come up with these names? No more severe compared to where we were 12 months ago. All indications are that this is the start of a new wave in Australia. I never thought we actually left the old one. If you look at all the numbers, there's more numbers out today than what there was 17 months ago, when everyone was forced to stay in their home and do things to their body that they didn't want to do, which is very interesting. We're closely monitoring the overseas transmission of the second variant. They're just a variant after variant. Look at these guys, right? Look at this guy. Look at this guy. It's crazy. It's crazy. So it says that there's 3 states where it's running rampant at the moment. 3 new states. This last week, New South Wales recorded 24 deaths from this thing, an increase from 16 the week beforehand. I remember when everyone was forced to do certain things to their body that they didn't want to do, that it was much less than this, right? But interesting, right? Interesting. But yeah, apparently this is running rampant again. Where will it go to? Hot off the press. Interesting. Fun time to be alive, right? So I just find the timing interesting, right? Some people believe in it, not being a smart ass, not, I'm not concerned by it. I've had it. You get sick, right? Things happen, right? But I start seeing stuff like this constantly popping up now. This is an article that just came out. Payment company Stripe cuts 14% or 1,120 employees from its workforce. So we've got here, a company has revealed the painful decision to cut 14% of its workforce, but has unveiled what impacted employees will receive. A global payment service provider called Stripe, which if you choose to buy something online, most of the stuff that you are buying online would need to be processed through a payment gateway. There's many different payment gateways that are out there. Stripe is probably one of the biggest ones that are out there, just like PayPal, but it's a different type of service. It's a back end of, most credit cards get processed through Stripe. It says here, when you think about it, right, it says here Stripe had employed more than 7,000 employees, and it was heralded as Silicon Valley's most valuable startup last year with a valuation of 94 billion US or 124 billion Aussie. When you think about what a bank has, right, like I think if you look at the big banks on Wikipedia or that, most of the big banks have like 40,000. So this company's up there like the size of a bank at that sort of level. But they've chopped off 1,120 out of 7,000 employees. Let's look at why they say it. So it says here the company's reversal of the company's fortune with the announcement of widespread cuts made on Thursday. Stripe CEO Patrick Collison said it was a painful change and he was very sorry to make the cuts after the company experienced a boom during the period we went through as e-commerce skyrocketed with people were trapped indoors. The world now is shifting again. We are facing stubborn inflation, energy shocks, higher interest rates, reduced investment budgets, and sparser startup funding, he wrote in a blog post. So what does that mean when I look at it? It's a reversal of monetary policy, folks. It's a reversal of monetary policy. We've been on a quantitative easing trajectory where they've been printing money, stimulating the economy, putting liquidity, like injecting liquidity into the market, right? And now they're taking that out of the market and everyone's trying to scramble and there's a lack of liquidity out there. So when we look at it here, they're blaming inflation, they're blaming energy shocks, they're blaming higher interest rates, but then they say reduced investment budgets and sparser startup funding. Why, if we're in a great world that we live in, is there less money for startup funding and reduced investment budgets? Well, something I'm going to talk about tonight is, and when I get into it, is about interest rates, how it affects the most families and whatnot. But basically, if someone's got 100 grand a year and their interest rates go up 2% on $1 million mortgage, that means that they're losing 20 grand a year. That means that they've got to stop going to the movies, they've got to get rid of the second car, they've got to do whatever it takes, stop taking holidays, whatever that may be. So as you see those things sort of fall into place, there's less capital out there in the market. And if we're looking from a greater perspective of all businesses globally, the liquidity is being sucked out of the market via, inflation, all those things. Like, I actually think that some of those things are very important, and is causing the effect. But, there's a lack of liquidity out there, folks, and that is causing the recession. It is now a recession, whether people want to admit to it or not. They're not calling it. I've not seen that we're in a recession anywhere, and I think that that's going to be held off for a long time. But when you go and speak to people out there, right, like I look at my businesses, and I've never been greater with what we're doing, right? Whether it be the investment business, whether it be any of the other ventures that I run as a business, things are very, very good out there. But I'm seeing a lot of stuff and a lot of people. I went to the shopping centre beforehand with a mate, and we went out for lunch, and we needed to get, some dental floss, right? Random thought of the day, right? And we went through the shops, and there's 5 holes which used to hold shops in them, and they've just closed them off, boarded them off, and put some nice writing on them saying lease me or whatever. And you're constantly seeing the revolving door of these businesses that are failing that are out there. And the more businesses that are failing, the less jobs that are going to be in the market, meaning that there's more supply of human capital than what there is of that, and meaning that there's more pain on the street, meaning that there's less spending, and it's going to go in the opposite direction. Just as we've seen everything go up, we're going to see it all come back. And that's unless they start stimulating the economy, which is why I find it, interesting about, the timing, because I said that between September, October, November in 2022, that we would see the recession forming, which would be 6 months out from the starting of them tighten monetary policy. Because it's not just monetary policy, it's not just interest rates that have gone up, it's not just, certain things like that. Inflation hasn't stopped, right? Go and look at everything that you've bought this year and tell me still at the end of 2022 that it's any cheaper, right? I guess, if we stop seeing the growth that we've been seeing, they may be able to smudge the figures. It doesn't mean anything's come back in value, it just means that it's stopped going up, but people can't afford their lifestyle that they've got now. So the next 24 months, and that's sort of why I've calculated somewhere in between the early to mid 2023 is when we're going to start seeing these stimmy checks pumping back into the system. I could be wrong, but time will tell, and common sense will prevail, because there's 1,120 people that don't have a job anymore, and if this is one of the biggest companies, what's going to happen to the rest of the companies out there? So it's a good indicator, right? So if there's less commerce that's occurring, right? This is a very big indication. There's less commerce happening, meaning there's less payments and transactions going through, meaning that these guys are losing money, meaning that they have to cut their staff. It means that it's going to flow on to the rest of society. So just look at the little signs that are out there. If we take a little look around into, and I'm not trying to be negative today, guys, I'm really excited and really optimistic about what's ahead of us here, because whilst we start seeing these little glitches, whilst we start seeing, 2 years of excitement we've seen for the last 2 years, whilst we might see 6 months worth of high interest rates at the moment, things do pass, right? And what we're faced with today will not be what we're faced with 12 months' time, or not what we're faced 24 months' time, but it's how you come out the other side and what you can take through that cycle to be able to take through to the other side, which is, ultimately how you're going to be benefiting or losing. So this one here, another bit of comedy. United Kingdom likely to see the longest recession since records began, the Bank of England says. So this one here came out on the 4th of November. And this article says the United Kingdom, the world's 5th largest economy, is probably already in a recession. It's probably already in, right? So imagine when they report that it is. Imagine how bad it's going to be anyway. and it could end up being the longest the country has seen since records began. The Britain's economy might not grow again until 2024. Wow, what's the problem, right? If we are looking at the longest recession we've ever seen, right, that would mean that's actually quite interesting, right? Because if you go and look up the definition of a recession and you go look up the definition of a depression, a recession is 2 quarters of negative GDP, right? So it would be 6 months of negative growth, which means that if you're in a recession, you would be out of the recession in 6 months. A recession doesn't go on for a year. That is called a depression, right? So they're saying that the UK is most likely already in a recession, and it may not come out until 2024, which means that it's a depression. And they're saying it's the longest one since the records ever started. Interesting. Get a bit of understanding about the numbers and the definitions and the words that they're using. It's quite interesting. That was the dire economic outlook from the country's central bank as it ratcheted interest rates up by 3/4 of a basis point to 3% on Thursday. A lot of people are scared. Interest rates here in Australia have gone up from 10 basis points to, and they've gone up everywhere, to 285 basis points at the moment. So it's gone up 275 basis points, 22.75% from the 10 basis points 6 months ago. So each country around the world has now got, a much higher interest rate. But when you look at it and you think 3% interest rate, the world's going to cave in. If you have a markup on that, you have the bank's premium that they make, you might be paying 5%, you might be paying 6% at the bank. In a lot of people's situation, if they've owned an asset for a long period of time, if they've got a low LVR, if they've got a high cash flow on it, doesn't really make a difference. If you've pushed yourself to the extreme, you've bought yourself a principal place residence for $1.5 million, you have $1 million loan on it, you're paying an extra 2 or 3%. 3% extra on $1 million is 30 grand a year. If you are going through a recession, you don't have a job, how are you going to pay for that, right? So that's where the calculations come out and you go, okay, well, how long can this sustain for before they have to reverse monetary policy? Because it's not just the people that own the properties that will go broke, it will be the people that, there will be the banks and the institutions and the investors and every bit of fabric of society as we know it in Western civilization that would be in a lot of problem at that point. So, most people are scared and they're like, Australia, we've put the interest rates up 25 basis points, right? Here we are with 75 basis points, right? And if you ask me my thoughts on where interest rates will go to next, I think we're at the top of the cycle globally. We may see another 0.25%. They may go up another percent, right? I'm going to stop, saying the dates they're going to go up. I actually will keep saying the dates that go up, but a lot of people are like, Birch, you said that interest rates are going to go negative, and I believe that they will. I believe that just as much as the pill that they gave everyone back in 2020 is the same pill that caused all the problems we've got financially today with inflation and whatnot, I believe 1000%, I'm very optimistic by this, that the pill that they're giving everyone to try and get rid of inflation is going to be the catalyst for them to have to print out and send us into hyperinflation. So it doesn't matter what happens in the next 6 months, it doesn't matter what happens in the next 12 months, 24 months, where are we going to be in 3 years, where are we going to be in 5 years? Ultimately, there's only one thing that they can do, and that's reverse the cycle of monetary policy, which they're in a tightening phase at the moment, and they've gone way beyond what they should have. They've gone way behind. They had 0.5% that they could have increased it without causing a depression. They've pushed it way up, right? They've gone like 8 times higher than that, and or 6 times higher than that in most circumstances, and that ultimately will cause them to have to be forced to reverse this policy. So let's read through this article some more. Like many countries, the UK is struggling with the cost of living rises associated with the illness shock to the economy and energy issues exacerbated by the Russia's war in Ukraine. But Britain has also contended with uncertainty caused by its chaotic exit from the European Union and most recent political chaos in Downing Street with a revolving door of Prime Minister. Well, I think there's a lot of stability now that you've got the World Economic Forum bloke here that was placed here. Let's not get into that, but if you know what I'm talking about, you know what I'm talking about. Some commentators have said the recession may mean that Mr. Sunak will try to put off for an election until the current government's full term ends in 2024 rather than risk going into the polls in a downturn. Downing Street said Mr. Sunak knew it was worrying time for Britons and difficult choices would have to be made regards to spending. The number one priority for his government is bringing down inflation, he said in a statement. Well, when we start seeing him, I'm going to leave it there. When we start seeing him bring down inflation, we're going to see a massive recession. And how are they going to stimulate it again? I believe it will be in the format of giving people a CBDC. And I don't think all the infrastructure's there, but there'll be a trial, there'll be another trial, there'll be another trial, and that's why the rest of this decade is going to see, shocks where we've got a boom for 12 months or 24 months, and then we've got a recession for 12 months, 24 months, and then we'll have a boom for the next 24 months. And they'll keep trying to control it, but eventually it'll just run away via hyperinflation. And that's, mark my words, I've said, I could be wrong, I could be wrong, but I've said way before we had inflation that we would see the inflation, we would then see it contract, and they'd try and control it, but they won't be able to, and then we'll end up into hyperinflation. So I do believe we're going to see hyperinflation as the day of hyperinflation. I can't give you that date. It depends what levers they pull. I never would have expected that they would have pushed the cash rate across the world. This is orchestrated. Every country around the world pushing the cash rate up. At the moment, Australia's up 2,750%. Interest rates have gone up 2,750%, right, in the last 6 months. It's unsustainable. Economically, it can't, and physically it can't be calculated to sustain at this level. Otherwise, everybody goes broke in the system. So, interesting. Last article of the day. The exact amount average Aussie will need to save for retirement is revealed. Oh, wow. They're going to reveal to everybody, right? We've been talking about this for many years, for a decade. Goes on to say the average Aussie may need to save around 75 to 100,000 a year just to retire comfortably, according to a new financial survey. The superannuation is a major asset in path towards retirement. The fund you invest with may not be giving you the full picture of where your money is going. I don't think any of them give you the full picture of where it's going, and most super funds look like something off Wall Street, but very boring version of that. The question I encourage everybody to do, and this is no financial advice, this is just being smart, being savvy, and taking control of your own life, is to be questioning, there's a few questions you should be asking looking at your super fund. So if you haven't looked at your super fund in the last 6 months, go and find out, log in, get your details, get it off your employer, whatever, go back to your super fund, see how much money did you have in your super 12 months ago, see what has it done. Is it higher or is it lower? How much contributions have you put in? If you've got 100 grand a year ago and you've got 90 grand now, or 95 grand, or even 100, well, you've made zero growth, and it's actually gone backwards because you would have put contributions into that super fund. And go and do that. That's the first thing you should be doing with your super fund, is seeing what is in there. And at that point, think, okay, who do I pick up the phone to and call at the other side of that? Do you know the person? Do you know what they do for a living, right? People go, oh, well, I know Birch, I've been watching him for 5 years. I feel like I know him, but I haven't picked up the phone to his office and called 1300-367-925 yet, right? But the people on the back end of your super fund that have got access to 50 grand of your money, 100 grand, 200 grand, 300 grand of your money, who are they? What are they doing? What is their belief system? What have they invested your money into? And what is it performing like? What fees have they taken out? And if you can't answer these without confidence, well, then someone's got a considerable amount of your money that you don't know about, that they've hidden, which, I think is important that everyone should have clarity on that. And that's, obviously why I am excited by the prospects of self-managed super funds for people, because you get to control what is in there. You're managing it yourself, and you're not paying exorbitant fees to other people to lose your money for you. This one goes on to read that they, throughout their survey, took hundreds of responses from retirees on their experiences, showing just how big their next egg would need to be for the golden years ahead. 42% of respondents answered between $75,000 to $100,000 was needed per year, while about 20% said the average person needs over $100,000 per year. Wonder how the retirees are going now that they've retired, and the cost of inflation has turned their 70 grand, which was a lot of money to retire on, into not so much, because everything they're buying has doubled. And that's something that you need to look at and project and plan and strategize and all that. And I encourage people to do that, not to wait until they're 60, not to wait until they're 40. The sooner you can, you should be taking control of this, right? You've got money coming in, you're going to pay it out to bills, to handbags, to subscriptions. You want to know what is the return I'm getting on that, because ultimately you're going to have to go and store your body, your time, your energy, your effort, in order to keep earning that, to keep the world going around like that. So looking at these numbers, it doesn't actually say, it does say here, to extrapolate to get to that figure, just to receive an income you receive from the full age pension, you require a lump sum returning 3% interest, approximately 835,000, or 5%, 500,000 you need in your super. For couples, you would need 1.25 million at 3% and 750,000 at 5%. Howard said that many retirees still retired with a goal of investing in assets that would provide a comfortable enough level of income to cover their lifestyle needs, leaving out other assets untouched. Some ended up dipping into their capital to make the shortfall in their capital base, he said. A vicious cycle takes place where they now have a lower capital base to generate income, combined with the lower interest rates over recent years. Retirees need to understand that they should be targeting a total return from their investments in retirement. So these guys here in the fund are saying, okay, well, you've worked your whole life, now you've got to, either die earlier because your money won't survive, or you need to keep using that money and you're going to run out of money before you retire. So, I think more so than ever, right, if we've got, if your super fund has invested into Stripe, which is that company we were talking about beforehand, I'll just go get it from over here. If your super fund was investing into Stripe, or it was investing into, what's that other one, Afterpay or ZipPay or whatever they do, and the price of those shares have dropped over the last 12 months, well, your inflation has gone up, what you need to be spending on has gone up, your dividends and returns have gone down, and your capital value of your investment may have gone down by 20%, 30%, 40%, whatever it is, right? So that is why it's important. And most people wait until they're 65. These articles talk about 65. The reason why they talk about you being 65 to retire is because then the super fund companies know that they can sell you their services while you're 25, 35, 45, 55. You'll be working, sending money to them every week. Oh, just saved another $500, another $200, put in my super. And you end up being their slave to feed their big fat Ponzi scheme, being the industry super funds. So I think it's important to take control of your life. Reality of it is, and what I've seen over the last 14 years of running this business, B.Invested, is it doesn't take too long to get out of the rat race. It may take you 10 years. Some people haven't done it yet, right? I've spoken to them 10 years ago, and for whatever reason they haven't got there. But I think on average, between 5, 8 years, you should be able to build yourself up in a position. Generally, it takes about 3, 4, or 5 years to build up the asset base to get you to retirement. And then once you get that asset base, you've got to wait 2 years, 3 years, 4 years, 5 years. The market decides that based on what is happening out there to your assets and the cash flows and all that sort of stuff. I know investors that over the last 12 months have been able to push up, 10 rents, $100. There's $1,000 a week, 50 grand a year. Yes, their expenses have gone up this year with interest rates, but what happens if interest rates just return to where they were at the start of this year by the end of next year? Well, then what would happen to their cash flow at that point? So just when you're doing your numbers, just go, okay, interest rates have gone up, and so many people are looking too much right at the minute because they're like, oh, interest rates, interest rates, interest rates, interest rates. But what happens in a year? What happens in 2 years? It's a different sort of market, so the time passes and goes from there. Just noticed something here on my desk. So on that note, topic of discussion for today is how to take advantage of a buyer's market, the benefits of a buyer's market. Something just hit my window. So looking at the market that we're in, firstly we need to understand that the market is not linear. Not everything goes up at once, not everything goes down at once. Rents don't just rise, prices don't rise. There's a reason why your prices have risen over the last couple of years. There'll be reasons why prices rise over the next couple of years. There'll be reasons why prices fall over the next couple of years. If we look at some markets, I'm finding, I'll give you a bit of a market update here on what I'm seeing out there across the spectrum in the property front. There is some inconsistencies in the markets out there. There's some properties that are selling for record prices. So I had a property, I just said I bought my dream home for today. I picked it up as a bargain, paid $4 million for it. I thought, shit, that's a lot of money. And about 5 doors up, just sold today. I got a text message, 6.6 million, which is good. I don't see how they do it, but it is what it is, right? So a record price. So that market, I'm seeing that things are still moving. $1 million here, $500,000 there, who knows, right? Who cares? I'm looking at areas which are in the mortgage build areas. I got a block of land sent to me today in Box Hill from someone, and the block of land was $630,000 or something, and the person that sent it to me said, hey, we're back at 2018 prices. And I don't believe we're at 2018 prices because they were much cheaper than that back then. But certainly off 12 months ago, they were selling blocks of land for $1 million, and now they're selling for 680 grand. So, those things were never worth what they are, the cost of building, but most importantly, the people that live in these properties can't afford to keep up with their, repayments at that sort of level. So, let's say, for instance, you've got a mortgage at $1 million. Someone has to live in that house for $1 million. Interest rates go up by 3%. That's an extra $30,000 a year that family's paying. That eats into the bottom line. They need to get a second job, drive Uber, menu log, stop using menu log, stop, cutting back on subscriptions, whatever, to try and keep the roof over their head. It's not a pretty life. But that's because, they are the only source of income. They're selling their time to get the income. If you had $1 million worth of property and you've got 5 properties at 200 grand, and you've got $300 a week rent coming through from each one, well then you've got 5 tenants bringing in $300 a week. That's $1,500 a week, 70 grand a year. You're still, positive cash flow based on just the interest component anyway at the moment. If you could just go and put your rents up by $50, $80, $100 on each one, well then you're probably making profit at the time. So it's important to plan that. I'm seeing those properties in the market at the 1.2, 1.4, 1.5 properties. They're not really moving out there, right? If I take a look at somewhere like Mount Druitt, for example, where properties are like 320, 350, 400 grand, the people there is still affordable. A lot of people that can't now afford, right? You may have been, a lot of people used to be able to service for $1.2 million, $1.4 million to buy a property, but because of interest rates rising, they may only service now for 600 grand or 500 grand. And that in itself is creating a pent-up demand in a different market segment. So if we look at the market from 2020 to now, I could rattle off, a dozen suburbs in Sydney where the properties are cheaper today than what they were in 2016. They haven't gone up, and in some instances they've gone backwards, right? But, we've had the cheapest interest rates, high inflation, all these rent increases, all that. Why haven't they increased? Because it just wasn't the right opportunity for that market, right? Everyone was getting their first home in a grant, so getting all these benefits of buying new properties. There wasn't as many people into these areas. But now the belt's being tightened, people's being pushed into these market segments, and it's causing little blow-up explosion mini booms that are happening there. One of the things that I've been pissed off about this week, like utterly fucking annoyed with, excuse the French if you've got your kids in the background, um, is properties that I'm losing because the markets are hot in certain price segments. So I've lost 8 properties since Sunday afternoon, which I've secured, got a deposit paid, got a contract back to the agents, and someone's come in and paid an extra 5 grand or an extra 10 grand. And those price ranges are between 100 grand and 350 grand. Though that market, very, very hot at the moment still. So yeah, not all markets are linear, and we need to understand that to be able to go, okay, where is the buyer's market? Because there's a lot of people out there that are thinking, oh, prices will fall, or now it's a great time to be buying, or we'll just wait, or I'm just going to wait until the market takes off and then go and buy. And it's like, well, I'd rather be buying in segments of the market. I haven't been buying in Sydney whilst the market's been crazy. I used to buy 40, 50 properties in southeast Queensland per month. Now I might buy 2, I might buy 3. I'm in different markets. I'm not seeing any retracement in that southeast Queensland market at the moment. If anything, I'm seeing it keep going up. So I'm not really active in that market. But as markets come off their cool, I'm like, hang on a second, this is a great opportunity. I'm going to go in and pick up things while they're cheap. So, have your strategy in place, because people will be thinking, it's natural to go, oh, I'll wait until things have hit a bottom, or I'll wait until interest rates start reducing, or whatever the case may be. But there's a lot of people there that are ready to buy. They want to buy, but they just can't get a loan. So, what you thought may not be the outcome that eventuates from what happens out there in the market. So have a plan, have a strategy. Opportunities that are rising. There's benefits of buying in a hot market, because if the market's going up, you can buy something for 200 grand and next month it's worth 300 grand. You just made 100 grand or 50% on your profit. But at the same time, in a declining market, some people will sit there and be like, oh yeah, it used to be worth 500 grand and now it's 400 grand. There must be something wrong with it. It might go down to 200 grand. You've got to use your common sense around it as well, and understand why are certain things occurring, right? Why is this happening in this segment of the market, but it may not be happening into another segment of the market? And it's all driven by, fundamentally, at the end of the day, the ability for people to be able to afford to buy those assets and make those things sort of happen. So for me, I love when something's on sale. I love when there's blood on the streets. I love when I'm picking up something that's cheaper than what someone paid for in the past. It's not necessarily a buyer's market in every segment of the market. I'd say it might be a 40% buyer's market at this point, and that could turn to a 60% buyer's market somewhere in the next 6 months, 12 months, as the heat gets caught into certain segments of the market. Certainly if you're going into greenfield estates and $1 million mortgages for houses without eaves, I would be buying with extreme caution. If you're buying a property below value, if you're buying a property that's positive cash flow, if you're buying a property that's below rebuild costs, I'd be quite aggressive on it, because there's a good pent up of reason as to why that thing A won't come backwards, and B could have buyers there and have a lot of market there. Specifically think about the servicing, because this game is not, I keep saying it to everybody, it's not a property game that you're in. It is a banker's game, and the banker's game is to the bankers are playing the game, right? And if people can't get the loans, then they're not going to be able to buy the property, which is going to cause a market correction, which is going to cause price retracement and opportunities for you to be able to go and take advantage of. And I like finding opportunities. I'll only be in a market if there's opportunity. If there's no opportunities in any market, well, then I won't be playing in the market. And I was very clear on that back in 2017, 18 and 19, because we were at a top in a fair few markets at that point in time, and we were going backwards in price. But in 2022, even though interest rates have risen, people are feeling poorer, all these sort of things, we haven't seen prices collapse. we haven't seen the amount of stock fall on the market because people are actually not, finding value in converting their asset to dollars, right? So think about it this way, right? If someone was to sell their property today and they make, I don't know, 50 grand on it, they're going to be paying stamp duty, they're going to be paying legal costs, they're going to be paying capital gains tax, they're going to be paying the agent's fees, they're going to be paying, just even the legal fees, right? They all add up and the cost of everything's rising. They might be sitting there and go, okay, I'll sell my property, I might make 100 grand, right? But what are you going to buy for the 100 grand on the other side of that, right? And the market that we've got today, there's a lack of stock in the market, which is very, very interesting. In 2006, 2005, pre-GFC, there was property everywhere, right? Like there was too much. If you look at stock in 2008, 9 and 10, there was a lot of property out there in the market. But there's less and less stock coming in the market. There's stronger hands. There's a lot of people with massive amounts of wealth that you may not even realize, right? And I'm not talking about the elite people out there. I'm just talking about the everyday Aussie that bought a property 10 years ago for, I don't know, 400 grand and now it's worth $1.2 million. That person's got $500,000 in equity that they could tap in and do stuff to. And that's the opportunity. Like there's people out there that are doing that. There's people that are sitting there, they know that they've got it. They're not just going, hey, I'm going to sell my property. And there's a lot of educated people in the marketplace. So understanding that the markets aren't linear, but the benefits of buying in a buyer's market, if things are on sale, I'd rather be purchasing, right? It's just common sense, right? So people get fearful, right? Everyone was buying Bitcoin when it was $80,000 and saying, I'm going to be retired, I'm going to get a Lambo, I'm going to take it to the moon, and I'm going to be retired, and I'm going to call my child Litecoin or Ethereum or whatever, right? Because I had a belief in that. But if the price comes down on Bitcoin from 80 grand to 5 grand, I don't think many people are going to be buying it because they'll be fearful of it and all those sorts of things, right? And the same thing goes with property, right? In a buyer's market, look for that opportunity, right? Because idiots had come and paid more money beforehand. All you need to do is go and find that idiot again and find that right environment. Why did that occur? Why was that idiot able to come and buy the property to start off with? It's because monetary policy was there. It was because propaganda was there. It was because the belief system was there. And in the banker's game, they need that system to be there for the next person to show up to the table and do the transaction. So, just bear those things in mind. A very important thing to think about during this time as well is that interest rates as they're rising up, I like to outsource everything that I do, right? Whether it be the cleaning of my house, whether it be the mowing of my lawns, whether it be doing things that I just don't want to do, or doing things that I can't do, or whatever. That's why I've got lots of staff. That's why I leverage. I like to outsource my expenses as well. So if interest rates go up, I want to outsource those interest rate rises into other people paying for those rises. So that means rent increases occur. So, factoring these sorts of things in, there's a lot of people that can't actually do this. And I think in 2023, there will be, certain pockets and segments in the market, if monetary policy doesn't change, that people will be forced, or a little bit more, their hand will be forced for them to have to make difficult decisions for themselves. So at this point, we haven't seen repossessions yet. We haven't seen people fall serious default, but that may happen, right? And if you think logically, like I've been playing for the last 2 years in a different market space than where I was 2 years prior. And that's because I didn't want to play in the hot market, I want to play in the buyer's market. But in certain segments of the market, it's hard to go bankrupt if you've got 150 grand properties. Hard to go bankrupt if you've got a 250k property which rents for $350 a week. So those things there you're not going to see crash because prices, because interest rates have gone up, whatever the case might be. But if you look at other areas of the market which may have, I'm looking at principal place of residences, I'm looking at development sites, I'm looking for the larger ticket items, those things there, if there's no cash flow attached to them or the cash flow is very poor into that market, there could be a bigger opportunity to take advantage and capitalize on that. So, yeah, looking at the markets out there, it's really a two-part market. Some markets are all guns blazing. As I said, in Mount Druitt in Western Sydney, I was told on the weekend there was a record sale in one of the unit complexes, an old red brick unit. It's the highest price it's ever sold in the complex, and it's kind of up there with the highest sale in the strip, which is interesting. But I'm seeing price reductions, on $1 million blocks lands down the road 20 minutes. So, yeah, look at those markets if you're looking to. It's something very important as well. If you are looking to take advantage of the market, whether it be today or there's people out there that are trying to time the bottom of the market. This is something that is really important. With all these interest rate increases, a lot of people said, I'm going to wait till the interest rates hit a peak. I'm going to wait till prices fall. But they haven't done anything to plan for how they'll actually execute at that point in time. And what I mean by that is that there's people that could have serviced for $1 million worth of additional loan with a Big Four bank, or another $500,000 worth of additional loan with a Big Four bank 6 months ago. But now they don't service with the Big Four bank and they might have to go to a second or third tier lender. Those people can't take advantage of the market, or they may not be able to access the equity that they would have. So, yes, if you're going to buyer's market, understand why it's a buyer's market, then understand how can you protect yourself and position yourself to take advantage of that market when it does arise. So I think this one may be a little bit too late for people right now. I've talked about it previously, but probably not as much as what I'm about to say. But make sure if you are planning on buying in a buyer's market, that you go and get your equity out when you can, that you do restructure your debt as soon as you can, and get yourself finance ready to be able to take advantage of that. Because a lot of people thought that they could have done stuff 6 months ago, but not factoring. They go, yeah, I'll buy it, but not factoring in that now they can't service, meaning that there's a bigger gap there. And even though the market might be cheap and there might be opportunity, they can't pull the trigger and make something happen. And it doesn't mean that window is closed. It just means that if you're one of those people that are stuck with servicing now, A, contact Zinger Finance and see what we can do for you, but B, just look at, okay, why can't you service? Most people can't, that are stuck and they can't service at the moment, is simply due to interest rate rises that have occurred recently. There'll be a point when interest rates start to come down, and that might be the middle of next year, it could be the end of next year, it could be whenever it is. I'll just leave that one there with whenever it is. But when the interest rates do come down, it means that your servicing will increase. However, the prices may not have taken off at that point. So if you have missed a window opportunity on the entry into this market, then make sure that on the other side of this market that you don't go, oh, okay, I can service now, but I'm just going to wait and see what the market does, because generally that's when people are out there taking action and they're like, we can buy a property, let's go do it. And then by the time the next boom cycle has occurred, you'll be looking back going, shit, it's taken off, and all that sort of stuff. So in short, I would much rather prefer buying a property in 2022 into 2023 than what I would have been buying a property in 2021, where you'd have 20 people at an open home and the price would go over the asking price. You'd be forced to do an unconditional contract exchange, but now you can negotiate on the price better, there's less competition against you, and ultimately you're going to end up with a better deal, and that's where the opportunity comes in. But who's to say? I ain't seen prices fall 20% yet. I haven't seen prices fall by 40%, as per the media was saying a few months ago. So on that note, I'm going to go to your comments and see what you have been asking. If you have any questions, flick them through. Can he chant? Same with PayPal. They're losing the plot. Alex, before you buy products, they have to be purchased and freighted. Purchasing is the PMI index, which is signaling major recession. Air freight FedEx has reported dismal earnings and flagged we're in recession. Sea Freight, Mazurk has reported the same, flagged the recession in line with the Baltic Dry Index. Yet somehow central banks are useless in reading these indicators and are hiking way till something breaks. And something is going to break when you have a $4 quadrillion global derivative supported by an $80 trillion global GDP. It's going to be bad, but the central banks have no idea. Interesting point there, Alex, and you are 100% right. But the one thing I'd say that you may not be right on is that the central banks do have an idea of what they're doing. They are just doing what they need to do to be able to push forward. So if we had 10 basis points on the interest rate and we're in a recession, they'd have to drop the interest rate from zero to negative interest rates at that point. Now that they've been able to push them up so high, they can say, well, look, we're giving you free money back, right? Interest rates coming down. But ultimately, we're going to be back at zero interest rate policy. And I think this is 100% known by the central banks. I don't think that they're oblivious to it or that they're dumb. I do think they're dumb, but I think that they're oblivious. I think that they're doing it because they need to do it. Chad said here, super ain't doing SFA lately, wouldn't rely on it if you can help it. Exactly. I feel bad for people when they hit to the age of 65 and, they go, I can get 20 grand a year income from my super, I've got to sell my house, I've got to live in a camper van, whatever the case may be. I think everybody should be aiming to build their retirement. And I think it's very possible. Like, as I said beforehand, doing this for 14 years, I've seen people on averages retiring sort of 5 years, 8 years, in that sort of period. You need to build the portfolio out, you need to collect all the assets, and then you need to extract the cash flow from it. And what else we got here? Morgan said every Tuesday night, G's me up to buy more property, 2 more by Feb. Let's go. Awesome, Morgan. Good work with building out the portfolio. No one has a more vested interest in your well-being than yourself, so make sure that you do have a strategy, you do have a planning, you do take the right steps in order to get there. All these things will pass. People forget. Now we're entering into 4 years from 2019, right? We're going into 2023. That's 4 years since the year where the alleged thing started. People forget what their world was like back then. It's only 4 years, it's nothing, right? People forget 2 years ago, people forget 1 year ago. And 12 months, a lot can happen in that period of time. So look at the bigger picture, have a bigger picture, and that's what you need to work towards. What I've got here, Brad said, I have a bit to do, some more research as I have a defined benefit super fund. Apparently it is better, but I'm still confused. Brad, I can't give you advice on that front with a defined benefit super or anything to do with your super, but a defined benefit is a very rare super. They don't do them anymore. They don't make them anymore. I think the only people that really get them are military super funds that are defined benefit. And every time I've spoken to a good financial planner, they've always said if it's a defined benefit, never touch it because it's a very good one. So if you do want help and want to speak to someone regarding your super fund, reach out to the team, flick us a message, give us a call, 1300 367 925, send us an email, admin@binvested.com.au, and my team can put you in contact with someone qualified to give you that advice. Melly says, can you drop through the best way to contact you guys, please? I just did. Send us an email, admin@binvested.com.au. Call us 1300 367 925. And my team, I was literally outside on the floor before I went on the live, and I've still got my team here. They're working with my investors, and they're always working. We've got a very committed team. Matt said here, Rido's you a carton, mate. You were on the money with the 0.25. I know I was on the money with the 0.25. I wasn't on the money with the fact of how high they would actually take them to, because I thought they would be stuck at 50 basis points, but they've smashed through the support levels. And ultimately, the higher that they take this, the more carnage that they cause, the greater it's going to be on the other side, and that's the exciting part. But I was right, and I will report back over the next week to 2 weeks as to what I see happening in the December meeting. Obviously, they don't meet in January, and I do believe we're at the end of the cycle with the increases in my gut, but I could be wrong because I'm not the one pushing the buttons at the RBA. Jem, and he said, "Hey Nathan, do you see value in Gladstone?" I do. I've got 2 motels in Gladstone. I've got shops and strips of shops in Gladstone. I'm pretty well invested in the Gladstone, but I bought into Gladstone when I was buying for 50 grand a unit for people, when I was buying 60 grand a unit, not 200 grand a property. So there is some value out there, but it's not a market that I would jump in and say, oh, let's go all in. But I still do find value if you can find at the right prices in the right areas. Yes, there's still good value out there. Nathan says here, is servicing calculated on the interest-only payments, or are they calculated on predicted payments of principal and interest? Each bank is different. Some calculate P&I and some calculate interest only. Depends on the lender, depends on how they do their back-end calculation. It's important to run through with your broker and say, okay, what's this bank doing, and what's the what's the best bank and best option for me, and how do they calculate things? Because the cycle of a property investor and their journey isn't just one bank's going to get you there. They have limits, they have caps on how much they can lend to you. Most banks cap out at about $2 million is what they can lend to you. There's a cycle. I see people go to second tier lenders and third tier lenders where they should be going to the big 4 banks to start off with, because you've got better opportunity to pull out equity and all those sorts of things. So any insights into the Tasmanian market? I buy on the mainland. There was heaps of hype in the Tasmanian market a few years ago. The market doubled, went up a lot, but I'm not familiar with the Tasmanian market. I see better value in places like Sydney and in Perth and in Queensland than what I do in the Tasmanian market. And I say that based on population, by infrastructure, by demand moving to that area, and the possibility of projected growth as well as cash flow. So I see a big risk buying into that market because it has been pushed up so high from where it was a couple of years ago. Robert asked, when do you think the market will skyrocket again? The market will skyrocket again when they change course in monetary policy. A lot of people will be scared when we are told we're in a recession. I will be doing Facebook Lives, laughing and throwing things around and all of that as they start to change course. And the writing will be on the wall when they start changing monetary policy, and it will take 6 months, 12 months for that to kick in and for us to go through a boom. The boom started to be seen at the start of 2021, not so much in 2020, but the boom actually started in and around March 2020, and it wasn't seen for that because there's a pent-up demand. So I'll be able to tell you when it does come through, but it's not at the moment. There is some segments of the markets which are booming, and they're predominantly the 100 to 350 price range is still very, very hot, and a lot of activity happening in there. Chantel said, we want to invest with you, but the NRCC in Lisbon is trying to screw people over with their buyback scheme, which is really just cheap land grab for the fast rail work smart city. I looked at that. It was interesting with the fires when they came out, the Clara and the Artec lines. There's a lot of rail network going through. Sorry that you were caught up in that, to hear that you're caught up in that. Hopefully everything's okay with you guys there and you haven't had too much damage with what's been going on this year. But yeah, it's interesting, the agendas and the smart cities and all the things that they're doing. It's like when you see that they're gonna do this for good, right? And they're gonna go green over here, and certain bits of infrastructure are being installed, certain pushes are being made for that. You need to question basically whatever the media is telling you to do, whatever the government is telling you to do the opposite, because that's where the money's at. Andrew said, hi Nathan, does Rose help with self-managed super fund loans? Looking to move my loan to another bank? Yes, she does. Reach out to Rose and see how she can help you. Dave said, is it good to refinance all loans every couple of years, or is it better to keep the same loans going for their full 30 years? Just depends. If you can refinance them to the big 4 banks and all that, great. It depends, if you're going to be refinancing into a better loan product, if you're going to be refinancing to pull out equity, what is the benefit of you refinancing? If you are going to refinance with a worse off position, or if you're stuck, then it might be better just to leave your loans where they are. So it just depends on your position and what you're benefiting out of doing that refinance process. So I guess on that note, I just saw the clock tick over 1 hour. I'm going to try and leave it at that for this week. Lots of information out there. We constantly get questions from the community asking, what should I do in my position? How can I get ahead? How can I plan better, etc. And it all starts with having a strategy. And sometimes you've got a strategy, it may be working, but you need to plan and change a few things around to take it to the next level and have someone to talk to. So on that note, there is a link in the description if you want to reach out to my team. I've got a very, very qualified team. I've got hundreds of staff that are here to help you on your journey. Reach out to us. There's a link for a discovery session. I can see that I've got my investor relation team here doing work still. It's 8 o'clock on a Tuesday night, helping investors out. So reach out to the team, see how we can help you with your journey, and go from there. Thanks a lot for tuning in, guys. Keep taking action, keep making the right moves towards your financial freedom to live life in your terms, and get there in the fastest way possible. Don't be waiting until you're 70 years old and parts of your body don't work. Make sure you live your life now, and you live it on your terms. So we'll catch up soon. Have a great week, and I'll see you next Tuesday. Bye for now.